Everyone, welcome to an Options Income Blueprint, Options Income Weekly live on August 8th, 2022 at 11 a.m. Eastern with Michael Schulman. And my name is Emily Norris with Traders Reserve. We'll be going over last week's results as well as when to accept shares versus roll. If you have any questions, please put those in the Q&A box and we'll get to those once we've wrapped up. We are recording this and we'll be posting it to the member website as well as sending it to you via email today. With that, I'll let you take it away, Mike.
Thank you, Emily. We have a session tomorrow. There is no live trading next week. We'll be putting on new positions via alert, but there is no, in fact, in any of my services, there are no webinars next week. People are traveling. I'm traveling. I do webinars when I travel. Dave Durham does Dave once did a webinar sitting in a corner at an airport. I've done webinars from a bathroom, twice from a bathroom, and once from a laundry room. And one member said, if you're doing from a laundry room, we should be trading Clorox. So you get used to this after a while. And I do want to talk about rolling and some of the math of the Devon position that we did last week, because I get questions. How do you pick this? How do you pick that? And I think it's important that you understand a little bit on the mechanics of what's going on. We had a busy week last week. And we opened and closed a bunch of positions. You can see there were very, very nice rates of return. We pulled in a lot of cash, and it was a good week. And one of the things I need to impress upon people who are relatively new or who haven't been in a lot of these trades for a while, if you come in and you're a new member, or you came in 3 months ago, you say, oh my God, they've lost money on Marvel, General Motors, all these. We haven't lost money. We haven't closed the position. And it sounds arbitrary. It's not. I've never considered any position to be a loser. It's a paper loser, but not a real loser until you really close it. And the second thing is we got massive hits early on, late November, and then we got hit again. We got November interest rates, January interest rates. I assume that was it. And then we get hit with Ukraine. So you put the three together. And my view is, of course, when you're deep in the money and it's still a very good company, if it's throwing off cash, and take a look at these results, it clearly is, you stay with it. So if you entered these trades anytime after, I would say, the middle of February, you're printing money hand over fist with gigantic rates of return. So I got an email from a brand new member. That's why I'm saying this. I didn't have time to put a slide together. Don't take a look at, when you're taking a look at the open position list. Remember, some of these have been open for a year. And the philosophy that I have that long-term members really, really like is, if it's a really good company in the real world, we stick with it and trade through it. So as you can see, we had a really, really nice rate of return. It was 41% annualized. We've had elevated volatility in some of our rolls, which is very, very nice, in the General Motors and Marvels of the world. And we also, we sold some out to the 19th. And Emily and I were just talking about making sure you understand it's not because we're not trading next week. By selling something to generate the cash we want every week that is expiring in 2 weeks and not 1 week, it gives us a chance to either close early or roll up to a higher strike price. And it also protects us against a market sell-off. So there's a logic to it. I'm doing it in the Income Masters program as well, of selling longer dated options. In 2 weeks isn't exactly the end of the world in terms of length. And that gives us more flexibility in a volatile market to manage the position. And so is the overall performance. It was really nice. And I don't know if we can keep up a 1.1% return on every week. That would be 50-something% a year. But we had some underperforming weeks. We're well above the 26% goal for the calendar year. So please, again, if you're new, these rolls, and we specify whether I recommend you should be doing the second leg of a roll, they're a great way to generate income. So last week in the market has liked earnings announcements. There was a good piece on CNBC breaking, I don't watch the TV, I mean on the website, breaking down. We have about 70%, 70-something% beating expectations, which is the norm. And of course, we've pulled back sharply on some companies that missed, such as a Roku, or that had middling forecasts. The market so far likes the Fed. The bond market, bond futures are used as a predictive metric for what the bond market, which affects the equity market, thinks the next Fed rate increase will be. And so we saw a little bit of a sell-off after a very strong jobs report. We went from about a 0.53, 53 to 47. I think there'll be a 0.75% rise in September. It went to over 0.6. But the market's also warming up to a not so big a slowdown, pardon the grammar. And what I mean is they're seeing that there is a slowdown. Profits may not be the robust that we saw pre-pandemic, but they're still pretty good. And that we need to live in a new normal where, oh my God, you have to pay a living wage to someone to be able to hire them. Forgive my sarcasm. There's a new Hulu series, I think it's called The Bear, and it's the real gritty reality of restaurants and why 1 million restaurant workers have not returned to working in restaurants because they don't get paid enough. It's really not complicated. And so the market is warming up to these realities, and maybe not so big a slowdown, that the places with the toughest hiring are at the lower end of the wage scale and are in service industries that are visible but not necessarily critical to the economy. Calm has returned to the market relative to what we were at 6 weeks ago. We're seeing a return of stock picking, and that's reflected in how the market has reacted to earnings announcements. What does that mean? That means that investors are pushing back against traders. Now, we think like investors, we trade every week, we trade for 4 days, we trade for 17 days, what have you. But I have an investment approach, which is this a good company for the next 3 years? And they're pushing back because you're seeing more volume coming in on really good companies that had been trashed with everything else, such as the Microsofts of the world. And there's my typo, 2 typos, because I typed it in about 2 seconds before, because I'm going, wait a minute, a real marker for a couple of industry sectors will be Disney, which for those of you who are in masters is an open position. Disney is reflective of 3 things, which is how big is the boom to travel after Labor Day, how big is streaming, because they're now valued, their upside is based on their streaming, and consumer spending overall. So it'll be interesting to see what they say. I think they announce, I think it's the 18th, but it's either the 17th or the 18th. So to roll or accept shares, last week we sold a put on Devon Energy. And this is very important. It's a stock linked to a commodity price. I treat those differently. Part of it is early on in the history of the service, I got burned on coffee and I got burned on oil, and not going to happen again. And so I try to avoid something that has a direct mathematical or linear relationship to an exogenous factor I can't control. Like if the chairman of, if the guy who runs Saudi Arabia drops dead, what's going to happen to the price of oil? Or if Vladimir Putin drops dead and the Ukraine war is over, what's going to happen to the price of oil? So you have to be very careful and nimble. And for this reason, I'm typically willing to take a small loss or prefer to roll the puts. But the first thing you do, because we obviously didn't accept shares in Devon, is you do the math on what it would be to accept shares. And this goes to the heart of the answer to many questions I get. How do you pick the strikes when you're rolling? It's math. But let's review the trade. We sold the Devon August week 1. It was $58 was the strike and 51 cents. Very nice return for 4 days if it had rolled, if it had expired worthless. Then we rolled down to the 57 put for 85 cents. And the goal was, we still want that 26% or more rate of return, reduced exposure to commodity stock, and if possible, roll to a put week and close early. So I'm not really actually going to say when we should accept shares. That you're going to see in the math in a couple of seconds. There was no point even thinking about accepting shares. Plus, it's a commodity. So these are rough numbers based on Friday afternoon that I put together, and I'm not going to bore you by walking through the calculation, except to say this: the calculation is not based on the original trade. The calculation is, what's the cash rate of return on the new put for the period of time you're rolling, which is 8 days. Friday to Friday, it sounds like 7 days. In the trading world, it's 8. So, and so rolling out to the 19th is 15 days, and that's how you calculate. And it's in the training materials, if you brand new and don't know how to do it, on how to calculate an annualized return. So these are rough numbers. And they were very, very rich numbers because oil has been very volatile. So you have to get back to this thinking, which is, I'm willing to take a small loss, and I'm very conservative about when I'm in a commodity position. So please keep that in mind in terms of flavoring as opposed to framing what we did. These are the framing numbers. And so the numbers that you saw here showed that we picked up 85 cents. It's $1. We now have $1.36 in cash, which is a very high rate of return if this expires worthless. Okay, it's a very, very high ROR. But my math was about what is the roll itself. Now, the target for me for a roll is to try to get 18% annualized. So that's the new cash from a roll divided into the strike price of the put. Okay, and then you divide that by, 360, you multiply that by 365 divided by the number of days in the trade, which is 8. That's the way, and you can't do any kind of analysis here without annualized returns. So the annualized return for this roll that went out was double what I was hoping to get. And we also had the advantage, it lowers our exposure, it increased our cash significantly, and it increased our rate of return. So that's the logic. I don't want to, there's plenty of material in the trading materials. This isn't a training session, but I wanted to give you a flavor of how I think when we're doing this. Should we get back to trading Roku? The premiums are off the charts. Well, the premiums off the charts means nothing. Question is, how are the charts and what are people thinking about Roku? Let's take a look, because there was a analyst downgrade, which I think was a mistake. But that's what, of course, moves the market. And let's see how Roku is trading today. So it's up. So the analyst downgrade meant nothing. And if you take a look at the chart, this is the 5-day chart, but let's take a look at the 1-month chart, which includes earnings. Here's earnings, and they were really not good. But take a look, we're right back to where we were. This is a sign of investors. This is an important point, which is why I wanted to answer this question live. Here we are selling off, going, the world has ended. No one's ever going to stream again, and no one's ever going to use Roku again. Let's get out of the stock. It's also short sellers making a profit, dumping their shares in the market because they want to close out the position. And yet Roku is a brand, is powerful in terms of its lock on being the middle person in the streaming market. It's a verb. It's I want to Google something, I want to Roku something. And you've heard me say this before. I recommend something to one of my sons, like Only Murders in the Building. He said, can I Roku it? It's on Hulu. I said, yes, you can Roku it. And so this is a fascinating chart that to me was what triggered the comment I made about investors are back. These are investors, because the results were not good, but they're going, Roku's not going anywhere. Management hasn't figured out how to what you and I would say would be properly monetize their customer base. But this is a complete technical overreaction. And now the investors are going, no. This is a dominant brand. And remember, the more you have advertising-based streaming, which will be Netflix, Disney's thinking of doing something. That's really good for Roku, and it's really good for the trade desk. It's really good for Roku because Roku gets a commission from signing people up. And I'm guessing a lot of people may cancel their Netflix subscription, wait till they have a new series that they want to watch. Then they're going to start their subscription again. And they're going to do it with their remote control through Roku. So there's investors are having a good time with this. But you don't, you don't do it because the premiums are off the charts. Well, let's take a look at the premiums actually. And they are off the charts. So if you want to trade something for this week and you only trade Roku with silly puts, 10% out of the money if it's less than a 2-week trade, and 15% out of the money if it's more than that. 10% out of the money would bring it down to 76. And you'd have a great rate of return. It'd be about 0.8%, selling a $76 put for this week. So we're going to trade it again. We may not trade it this week, but we will definitely trade it again. So why did Pfizer sell off and Moderna went up? They're both vaccine stocks. Well, I've been screaming this. I haven't been saying it. I've been screaming it. That COVID's not going away. Okay. And Wall Street still thinks it is. And when I mean that, I'm sort of tongue in cheek, but they're trading the stocks as if these vaccine revenues are ephemeral, which is weird. I mean, Moderna is selling at less than 7 times earnings, and I think forward earnings. Pfizer's 6, the market's at 16 or 15, maybe 17 now. because it's been up. So they're selling it less than half. They're selling it more than a 50% discount to the S&P 500, and they're both growing very well. It's because there's a basket of money for vaccine stocks professionally, meaning people are going to have split positions between the two, and they're going to sell off Pfizer and buy Moderna. Moderna has a much higher, for a 5-year investor, Moderna has a much higher upside. They have potential for cancer vaccines. The research arm for Pfizer's vaccines is a publicly held German company called BioNTech. So the upside for Moderna is 1,000 to 1,200 a share. The upside for Pfizer is probably about 100 to 120. So Pfizer could easily be a double and a little bit more in the next couple of years. I'm not saying it will be. I'm saying it could be, depending upon how the street does. If the street valued at the S&P 500, Pfizer's $100 right now. And Moderna would be probably about 450 or 500, its previous high. But one of the reasons that investors may prefer Moderna is, first, it's a pure play on aggressive use of messenger RNA. Now, today, by the way, Pfizer bought another company, a blood therapeutics company with a existing treatment for sickle cell anemia, and a couple in the pipeline. And it's all accretive, meaning it'll add, it might reduce earnings per share, but it adds to earnings overall. They're buying companies that are accretive, but that also have a pipeline. So their plan, obviously, is to take the huge cash flows from COVID and to keep building out their business. And when you're a legacy / dinosaur company that has a lousy pipeline or a lousy history of developing their own drugs, I'm only talking about the past few years, not over the past 30, but over the past few. They're just going to buy their way into new markets, and that's why the stock is radically undervalued. And so then we get back to what I was doing before, which is why and when do you take losses? And you take losses when the two things happen. One is the story in the real world changes. Okay, you have a company. One would be an example was ChargePoint, which is a electric charge. There are about 9 EV charging station companies. A few are publicly held. ChargePoint is the one that's most visible. And when I thought Build Back Better, and the market thought Build Back Better might actually get passed a long time ago, we traded it. And it's not a profitable company, or if it is, it's marginally profitable. And the story changed because without subsidies for electrical vehicles, you're going to see a less than super rapid growth in EV stations. It's very different in Europe, and it's very different, especially in Northern Europe, where EV stations are heavily subsidized. Now we do have them. But the point is, there was a metric that I had to keep in mind. And the other thing is, it's a speculative stock. So we had to be very careful with it. I'm not suggesting we may have taken, it was a master's program trade, I think, and I think we took a loss on it. But you take losses when also the reality in the real world changes, or the Wall Street, the way the Wall Street values the stock changes. So we took losses, again, not in this program. We took them in Yeti, Crocs, and Chewy, 3 consumer stocks in the master's program, and consumer stocks that hit a wall, and I thought they would be dead money for 6 months, which they were. Now, Yeti is on sale. It's the Cadillac of thermoses and coolers. It's a fabulous company, fabulous products. Crocs was hammered after an acquisition, and it was a post-pandemic crash, even though it's still growing at 50% a year and is a multi-billion-dollar outfit. Chewy, the book is out. We have to see what their next quarterly announcement is. But high price earnings multiples consumer stocks got hit by Wall Street hard, and it was time to go because I thought it was going to. I was correct. I was incorrect in that I recommended people go into stocks that took losses. I was correct in leaving because the stocks were dead money. So even though the premiums were very large, liquidity was drying up, and there was no end in sight, and there still isn't, when these multiples are going to get anywhere near what they used to be. So it was time to move on. So trading this week, stock picking, you may see some new names. I always like to give you a heads up on that. We do have a shrinking universe of names because it's August. Liquidity dries up in second tier names. There'll always be huge volume for something like General Motors. But we do have a shrinking universe of names. So you may see some names that we traded with some frequency, and we're just going to keep that cash, which, we saw this week rolling in. I am now exploring new sectors and names, and let me spend a couple of minutes on that. And I don't want to bore you with slides. In a perfect world, all my slides, the Traders Reserve, Dave, John, Emily would never let me do this. A million years ago, when I worked as the personal assistant to the head of computer sales at AT&T, he always emphasized he wanted, this is the 80s, late 80s, he wanted graphic slides. He said, I don't want people reading my slides. And he never gave handouts beforehand, which drives some people nuts when I do my in-person seminars, but we don't give although now we do them electronically because I lost that argument. So I didn't put anything together today, but I want to talk about the legislation that was passed. There are 3 pieces of legislation that were passed this year, which are going to have fundamental impacts on the American economy, which means fundamental impacts on some companies. And there's actually 4 if you include military aid to Ukraine. They are the infrastructure bill, they are the chip manufacturing bill, they are military aid to Ukraine. And they're what the Senate passed yesterday, and which will probably be passed by the House before the end of August, which is called a climate change bill. But it's a Christmas tree. I mean, whenever there's a major bill passed in the House or the Senate, and it has to do with spending money or giving subsidies, farmers always have to get their fair share. And I'm being sarcastic. They're the wealthiest, most efficient farmers in the world, but we always got to give them money. So they got 20 billion out of this too. And it's really the impact on solar. You'll see in the movement of stocks today, the impact on EV stocks. It's a big deal. Now, as you know, I'm a contrarian. I'm a short. I can't stand Tesla as a company or a stock. And the market agreed with me the last 6 to 8 months. And one of the reasons was in the previous subsidies for electrical vehicles, there was a 200,000 unit cap. That subsidy could only be provided by an electrical vehicle company 200,000 times in the life of the bill. And Tesla and General Motors were maxed out. And between that and carbon credits, that accounted for a lot of Tesla's success, not as a stock, as a company. Tesla's success as a stock because of Elon Musk's Twitter account and him being all over the place, and he's a cult figure. Well, the new bill lifts those caps, and that's a big deal. And I'm surprised GM isn't up even more, but a lot of people don't understand. They think they do, but they don't understand the EV business. They think it's all going to be startups and Rivian and Nikola and Tesla, and yet probably within 18 months, the largest EV company in the world will be General Motors, and it'll be pulling away from the rest of the pack simply because of size. Tesla really is a battery company that is selling batteries through its cars. And I don't think it understands that it understands it, but that's not what it's doing. The example would be Honda became a huge success by realizing it was a motor company and not a car company. So they always led with super compact, high performance 4-piston engines. And Volvo was the same with 6-piston engines and 6-cylinder engines. And General Motors' strength is they have a different battery technology, which isn't necessarily higher performing, but it's much more readily sourced outside of China. It uses nickel and not lithium ion. And the possibility of upside in performance of a battery is much higher with nickel than lithium ion. Lithium ion is a mature technology. Nickel is super mature and super new. The 75-year-old batteries were nickel, and now they're going back there. So you have to do all this, but the bill is going to be very important, assuming it passes in the House in the same fashion. It's very important for solar. It's very important for electrical vehicles. It's rather important for spending by farmers in and freeing up cash to buy things like fertilizer and so forth and so on. It clarifies methane regulations for what they call shale drillers. They're frackers. And there was a cloud, pardon the pun, hanging over that sector of the oil industry because of uncertainty about methane. There's a lot of methane that's let out. And there's more and more recognition because of this bill that natural gas is a good thing because it displaces coal and it displaces heavy oil. So I'm going to be spending a bunch of time. A lot of these stocks have run up, parsing what's real and what's not, and the impact that in the infrastructure bill and the chip bills over multiple years. And the issue is personnel, not capital. The chip bill, there's a in the bill in the climate change bill, these cars, by the way, have to be built with batteries and parts, US or US free trade partners which excludes China, and on purpose. And so they may not be able to make the dates, but the point is there's going to be a large reshoring of core technologies and factories. Is it investable? It may be, and it's a whole bunch of other names, but it's going to be slower than anybody would prefer. There's just a shortage of people, and I don't mean factory workers. What you're really talking about is line supervisors and factory engineers. We just don't create them in the US, and it takes many, many years to develop that cadre of talent. So be aware there'll be a lot of new names, and the next generation of new research supporting my services is underway. The other part of it is I always have ongoing research in biotech, even though most of it's speculative. Sometimes, I was ready when Pfizer and Moderna were in clinical trials. I was ready to say go. And it wasn't because COVID was raging. It was because the technology had stood the test of time. So with that, let's go to your questions.
Hey, Michael, Ben says, you consider being called out closing a position?
No, not unless I close it. So if we're called out on a Friday and the alert says we're going to sell puts the next week, the position is still open. Rule of thumb in your own portfolio, independent of advice I might give, is if you close out a position by, let's say, being called out, and you don't re-enter the position for, let's say, 3 weeks, then it's a loss or a gain, and then you start over. It's just an important discipline in portfolio management. It's arbitrary. I know I have members who don't do that. They'll sit out a month because the way they read charts, and then they'll get back in and they keep it as a continuous trade, a continuous position. Trades are not positions, they're different. A trade is a subset of a position, including being called out. So when we close a position, you'll know it. It'll be written up in an alert.
Hey, Nicholas says, I bought a few Rokus for my older TVs, but found my newer TVs do not need them because of the built-in app. Could Roku be becoming obsolete?
No, Roku, the built-in app, they get a license for it. It's much better than being in the manufacturing business. It's preferred. Would you like to have a device that has Google on it to do search, or would you prefer that Google be something you can use your browser? So Roku would love to get out of the hardware business. It's the reason they've missed their numbers. There's supply chain issues. Roku remotes, okay? And first of all, there's 2 things. There's a Roku remote. There's 3 things. There's a Roku device that can go in the back of your TV, and it has a remote that comes with it. Then my TV, I have TDLs. They come with a Roku remote. I mean, you hit the button and Roku comes up. That's a license. And TDL is responsible for getting that sourced. Roku, I'm putting words in management mouth. I'm sure they'd like to get out of the legacy business because it's a headache, and they make much more margin, right? It's all about profit margin, not revenue, if it's a license and it's an app. So instead of becoming obsolete, it's becoming more of a standard. It's actually going the opposite direction when something is on your computer, your television.
Hey, we don't have any other questions at the moment.
I'll yak for another couple of seconds and so you get your questions in. I don't want to, Emily and I were sharing members' questions, which we often do before we started, and people were asking, and it's because a lot of people don't go to all live sessions and they just read the alerts and they drop in for some sessions. We've had increasing frequency of why are we trading positions that are 2 to 3 weeks out. First of all, I used to do that all the time, and we went to shorter positions based on market conditions 3-4 years ago. We're going further out to give us more flexibility in managing in a market where if something happens at the nuclear power plant that's being shelled in Ukraine, the Dow could sell off 1,000 points. And you want to have a distant strike when you're getting started. And so that's the reason you're seeing more things that are 2 weeks out. And today in the Income Masters program, I think the alert went out. We rolled up First Solar. We had sold a silly put, a 92, and we rolled it up to 100 because the stock's now at 108. And I'm sure I'm going to get an email. Why didn't you sell 105? It's a August 19th position because the stock could retrace because of the market or because this is a short squeeze based on the legislation being passed. So I just wanted to emphasize that you will continue to see, as there's lingering uncertainty. A lot of it may end with the Fed meeting in September, but with lingering uncertainty, we will be selling puts deeper out of the money and further dated than we had, let's say, 6 months ago. Last call for questions.
All right, all right, okay, so about Devon, they said closing, okay, so it's an August monthly position. Just wait for further guidance on that if you can't close it for the price that was in the alert.
Which alert?
The alert on Devon was at, I think, week 2 pricing. So just wait for, I think it's at 170 now. So if you can't close it with a profit, just keep it open and hold on.
I don't understand. Did we make a boo-boo?
Yeah, so it should have been, it was week 2 pricing. It should have been monthly pricing. So just
Okay.
hang on and there'll be a correction coming.
Sorry about that. It happens. We have a bunch of open positions.
I don't see any other questions regarding. Yep, that's it for questions.
Well, thank you all. I will not see you next week, but we will be trading new positions tomorrow. We have a live session tomorrow, and next week on your calendar, look for alerts for new positions. Thanks a lot for coming in.
All right, thanks, Michael. Thanks, everyone, for joining us. We have recorded this session. We'll be sending you out your weekly e-letter with a link to this recording, as well as this week's article. And we do not meet for live trading, as Michael said, next week. So our next live trading session is going to be August 23rd at 11 a.m. Eastern. But please keep an eye out for alerts managing open positions, as well as putting on new trades. Thanks and have a good day trading.